Joel Greenbolt's billionaire secrets start with a phenomenon called Graham's formula. His formula involved purchasing companies whose stock prices were so low that the purchase price was actually lower than the proceeds that would be received from simply shutting down the business and selling off the company's assets in a fire sale. He called these stocks by various names: bargain issues, net current asset stocks, or stocks selling below liquidation value. Graham stated that it seems ridiculously simple to say that if one could buy a group of 20 or 30 companies that were cheap enough to meet the strict requirements of his formula without doing any further analysis, the results should be quite satisfactory. In fact, Graham used this formula with much success for over 30 years. Graham showed that a simple system for finding obviously cheap stocks could lead to safe and consistently good investment returns. Graham suggested that by buying a group of these bargain stocks, investors could safely earn a high return without worrying about a few bad purchases and without doing complicated analysis of individual stocks. The formula fared poorly 5 out of every 12 months tested. Annually, the formula failed to beat the market once every 4 years. If the magic formula worked all the time, everyone would use it. If everyone used it, it would probably stop working. The formula doesn't work all the time. For the magic formula to work for you, you must believe that it will work and maintain a long-term investment horizon. Timeless principles. In order for the magic formula to make us money in the long run, the principles behind ITAR must appear not only sensible and logical, but timeless. Otherwise, there is no way we will be able to hang on when our short-term results turn against us. We are buying on average above average companies that we can on average buy at below average prices. So, what is the secret sauce? In short, companies that achieve a high return on capital are likely to have a special advantage of some kind. That special advantage keeps competitors from destroying the ability to earn above average profits. So, by eliminating companies that earn ordinary or poor ROC, the magic formula starts with a group of companies that have a high ROC. Then you will buy only those companies that earn a lot compared to what we are paying. Why does it work? A good track record only helps once you understand why the track record is so good. The MF beat the market averages 95% of the time, 160 out of 169 3-year periods tested. The worst return was a gain of 11% versus a loss of 46% for the market averages. Here's another key point: analyze each company from the bottom up. Don't predict under or outperformance of the value cycle. Look at 1. What you pay. You would value EBIT higher if tax revenues are lower due to a permanent tax change. Take the after-tax yield and see what the differences are. Is EBIT representative of true cash flow? EBIT is a shorthand for EBITDA, MAIT, CAPEX. Different capitalization can skew net income. Differences in tax rates. Using EBIT is a way to compare apples to apples. Versus to what you earn, the denominator shows what I need to invest in the business to get that EBIT. Don't forget to normalize investment capital over the course of a year. Boil the analysis all down to its essence: is it a good business at a good price? Is the bet worth it? Don't throw out logic. Ask one simple question: how much do I have to pay? How much am I earning? All of these are major keys when deciding to buy a company. Take a gander at 2 businesses: Jason's Gum Store for $100,000 to build and $200,000 in operating profit, so 50% return on investment capital. Jimbo's Just Broccoli for $100,000 earnings, $10,000 equals 2.5% return on investment capital. But compared to the 6% government bond yield, Jimbo is actually losing 2.5% to 6% a year. This is crazy unless he thinks the profits will grow tremendously. Though it seems he is making a little bit of money, he is actually throwing money away. This is how Joel evaluates each business. What are they doing? He won't pay for a value destroyer. Stay out of value traps of just buying low P/E stocks. Is he getting a good return based on what he is paying, and what are the incremental returns on capital? What kind of capital does he have to put in to earn that type of return? What is he paying, and is this a good business? He is really looking at normalized EBIT 3 or 4 years out versus last year's EBIT. How much of the money that he earns can he reinvest at the same rate? The incremental return on capital will affect his growth rate. It will affect how much his dollar will grow over time. Then it will determine what normalized growth rates and earnings will be. That's the secret. I hope you enjoyed the video. Subscribe.